The broadcast is now starting. All attendees are in listen-only mode.
Hi, welcome everybody to this Casey Lau's Money Tip Show, and it's very excited to see you all here. Can you just type in good morning to CF here? We have my good friends Liu CF, Liu Chengfu. He's an independent financial planner, and he has I think done a lot of planning for customers in KL area and also in Penang. I think mostly in Penang, and good to have you here, Liu. It's fun to do this
Hey,
again.
good morning.
We have been missing this for
It's
quite some
been
time.
a long time. Yeah. Casey, good morning. Good morning to everyone.
Yeah, good morning.
Actually, good
We have some.
hazy morning.
It's still hazy, right, in Penang? I think in Klang very also we still got some haze here. So no, I think a lot of bad things is happening in our country, as everybody knows, and including the haze is one of it, which is I guess I guess is the most severe one affecting us. Yeah, I've heard like people they got allergy to the haze and I got hospitalized. I heard like several cases. Do you have friends like that?
Yeah, actually, I just recovered from sort of sore throat last week. So I would say I'll hold the haze accountable for that.
Oh, thanks for all those people who respond. We have Alfie, TP, Ting Ting, and Lee. Oh, great. So let's get started today. This is something about private investment, which I think is like alien terms to most of the people here, because when we talk about like fund, all the times you're talking about unit trust fund, where they invest in the public listed company, or maybe some fancy fund that invest in like commodities or even like global markets. But now it's like talking about private funds, so I'm also very interested to know about this thing. So let's get started with it, Liu.
Yeah, thanks, Casey, for the introduction. So just a brief intro about myself. I'm CF Liu, Ching Fu for short. I'm financial planning manager for Ching & Co Wealth Management. It's a subsidiary of Ching & Co Chartered Accountants, HQ in KL. So I take care of the Penang branch, the financial planning division. And Ching & Co also a practice of our standard FA. Right, so perhaps if I could switch on my webcam so
Yeah.
that the audience can see me. Perhaps they will be more interactive.
Okay, nice.
Let's see how this goes, right? Right. Okay, starting up. Yep.
Okay, see
Can
you.
you see me, Casey?
Yes, I see you.
Okay, right, that's great. Okay, hi everyone. Right, so let's get right to what I want to share with you today. Despite the hazy condition, right? I'm also like indoors. Right. So why this topic? After a long what we call a hiatus, right, on Casey Lau's webinar. Then Casey I said, hey, it's been a long time, so you do want any interesting topic? So I say that, hey, this topic might be something that relates very close to heart for many Malaysians. You see, because there's certain things that comes through our way for the past 2-3 months. Haze is one of them, and low commodity prices is one of them. Some stock market uncertainty, of course, and also when it comes to currency, I think that does not require any more explanation. So the thing is, if you are already invested in stock markets or most of the investment out there, it's likely that you'll be in one way or another impacted by the fluctuation in ringgit against USD and the fluctuation of the stock market, especially KLSE. So this topic actually talks about how to actually get away from all these what we call as volatility, right? Okay, in financial planning terms, the volatility in terms of currency or the stock market and all those stuff. Because this is a very interesting phrase that I picked up recently. They say when you invested yeah, in stock market, and let's say in Malaysian stock market, in today's environment, we say it's something like heads you lose, tails you don't win, right? Normally heads you lose, tails you win, right? But this means that heads you lose, tails you don't win. What it means by that is that, okay, you might have gained a certain amount, let's say with 10 or 15% in your stock portfolio, but if you compare it to ringgit value versus even Sing dollar or US dollar, you'll see that it has depreciated almost the same amount. And I really can feel for my clients who are mostly married couples that have plans to send their kids overseas in due time, right? Not too long, but not too short either, probably 4 or 5 years, right? Especially your kids are in secondary school. So what happened is they are accumulating for that, and they realize that, hey, I make some gains this year, but again, it was like offset by the weakening of ringgit. Due to what? Everybody knows. When ringgit weaken, meaning that if it stays weakened or worse, continue to weaken, you will experience a situation whereby this amount of money, you grow it to a sum already, and you especially want to send your kids overseas. So that is where the currency fluctuation, currency impact takes place, and you realize that you are really short of what you have allocated in the first place. So that's what it means by that. So of course, for those who don't know me already, this is my website, howtofinancemoney.com. You can check it out. Just a quick intro of my principal firm, Chen Chartered Accountants. And these are what we are going to cover today as promised, right? So I'm going to go through this real quick, but the thing that I want to stress is first of all, some disclaimer to say that this is not regarded as an offer to invest, right? Past performance is not necessarily indicative of future performance. You should always consult and know your own risk profile before investing. And lastly, there will be no disclosure of any names of any companies or any financial institutions for that matter, okay, in this presentation. Of course, I'm going to answer any questions on that, but if you're interested to know further, you can contact me directly after this presentation. So let's get right to it. Now, what is private equity, right? Mutual funds or even stocks, what we call as a public equity, meaning that anything related to this public equity, publicly available investment, the information are all publicly available. You just buy or sell those public security as whatever price you like, right? You feel it's undervalued, then you buy. You feel it's overvalued, you feel it's at reach its potential, then you sell, right? Again, value investing and all those concepts come into mind. So what is private equity? Now, private equity is a different beast by itself. What I say is by that, private equity is all about private sourcing and analysis. Now, what it means by that, private sourcing and analysis, meaning that there are deals, what we call investment options, that is not normally available to the public, but it takes a specific group of people or fund manager with this specific skill set, right? Not just any Tom, Dick, and Harry, specific skill set to know of this deal because of your personal or professional network. Okay, take this deal, okay, and most of the time it's identify opportunities for these deals. Take these deals, and the next step is do a due diligence. Okay, due diligence, as normal, you want to see whether what you are about to invest in, whether it's something that can lose money or it's likely to gain money, right? Or see whether the prospects are good or not for this kind of projects or startups or companies. Okay, after that due diligence is done, you close it. Close means that we'll go through more to this detail. Closing means that you sign an agreement to inject some capital into these projects or company or startup companies and things like that. So you actually sign an agreement with this what we call company itself to say that, okay, in these 3 years I'm going to provide this kind of capital to you, but after 3 years I'm going to cash out, and whatever interest that I generate from there, it will be mine. So this is what we know as closing. Everything has to properly documented.
Is that your phone? Is your phone ringing?
Yeah, right. It's my phone ringing.
Do you want to turn it? You want to turn it to silent
Yeah,
mode or something?
yeah. It's a bit some distance away.
Okay.
Is it very loud?
Yeah, it's quite loud. We can hear that. And then I think it's,
Okay.
it's like maybe blocking your thought or something.
Yes.
And then it's distracting us.
Yes.
Yes, I'm listening
Yes.
to the good music. So do you want like?
Yes.
I can give you a minute. You can go do that. No worry.
Yeah. I think it would ring again. I'll get through to it, but I think it stopped ringing.
Okay.
All right. So after the deal was closed, then it comes to active portfolio management. So the fund manager would have an active role to play in, or active role to play in some way or another in the direction of how the projects are being run or how the companies are being managed. Okay. And those deals are normally not public, okay, not public. And after, of course, certain defined time frame, they exit from this deal, cash out all whatever profits and initial capital from the initial investment.
So how is the exit plan like? Is that they are going to be like the private company is going to be listed, and then is that considered exit, or do they sell it to someone else?
Yeah, it could be exit. It could be equity or stake ownership, right? Imagine if you are we are investing Alibaba in the very early days, right? And guess we are the shareholder of Alibaba, right? At a price probably it's below IPO price or something like that. So exit meaning that you eventually, to summarize, own a stake in a company if it goes public. If it does not, then I'm going to cash out whatever initial capital that I invested plus the profit as well. So it could be one of the ways. These are the common ways.
Okay.
Okay. Keep the questions coming if you have any from audience or from you, Casey.
So it basically means private equity is you take part in a company that is still running business privately.
Yeah, that's right. Normally, yes. Private company or projects, I would say.
Okay.
Yeah. Again, private equity compared to public equity, what we call as okay, this is what I write. Okay, right. It is private equity is a different beast, and if you are not lazy and you do not have this herd mentality, okay, and if you're a long-term investor, then it could be for you. And why we say that is because this nature of public equity is something that it actually locks you down for a certain period of time. Meaning that, can you see, from deal sourcing to exit, that is the duration of time we are talking about, right? It could be 3, 5, or 10 years, okay? So in between, you'll be getting some dividends income, just like you're getting from stock. But your capital normally would be locked down, okay, to a certain extent, right? So again, if you look at it from another way, it could be also for someone who are impatient. Impatient, right? Like I say, it could be as short as 3 to 5 years. So if you want to see something of a return in 3 or 5 years time, this could also be with you, because in today's volatile market, one day you invest into something, let's say in public equity, and what happens if next year the stock market undergone a crash or certain correction? So it takes time to recover, right? And of course you say that, these are still good companies, but what if you really your funds accumulated and you need to use that in 3 or 5 years time for children education? So when we actually present this private equity investment option, especially to people who are doing business, to business owners, right? They actually resonate with business owners a lot, because they know that business actually, they say that for business owner, their main return from the wealth, right, is from the business, and that provides more than what stock market or even unit trust can provide to them, right? Of course, having said that, you will have a question to say that, hey, how about like well-known investor like Warren Buffett, or even one of your good friend, Casey, right? Mr. Kun Yo-yin, who just donated about 50 million cash, right, to Penang USM Hostel, right? So these are the what we call as an investor that makes a lot of money from public equity and stocks. But when we analyze one level deep down, you realize these kind of people like Mr. Kun Yo-yin or Warren Buffett, they are a better investor because they are a businessman first, right? They are not an investor first, they are a businessman first. So they think long term, and they think from business perspective. And that's why, the private equity is just about business. So if you are doing business, you're a businessman, actually this private equity concept actually resonates very well with you. Okay, I will go through the details how this kind of thing are structured. Okay, then this is info to say that why private equity. Okay, at this age, right? You can see that this very famous university, Yale University, in the U.S., and this university actually runs an endowment fund, like university fund. So it from its report, right, for 2013. In 1980, you can see that on the left, the gray color, this is the traditional portfolio of most investors, especially if you just started off, right, investing. You have like equity and fixed income, meaning the FD or bonds. So very traditional, right? We call that asset allocation. But now, now you can see that pension funds and all those big funds, EPF, they actually structuring the portfolio in a sense that it has quite a sizable lion's share of private equity, besides other things, of course, like foreign equity and real estate and whatnot, or natural resource, right? But again, this does not reflect every fund will have this kind of allocation, but just to say that private equity is actually growing in popularity in terms from institutional investor, the institutional level, funds level kind of investor. So you can see that they like this private equity because to a certain extent it's actually more predictable, right? More predictable if you have encountered the right deals and the right projects. Okay, any question, Casey, from our audience?
Yeah, we're good. Let's carry on.
Yeah. Just take 1 minute. Pause over here.
So here you show a chart of what is this, the potential return, like the annualized return of different assets?
Yeah, this is actually the annualized return. I think I forgot to credit the source, but I think this is from Bloomberg, this chart, right? I think this chart will actually more meaningful if coupled with this, right? So besides the return, okay, we also want to look at volatility, risk, because these two comes together. So what it means to say that volatility, it means that stocks, high volatility is likely to swing up 30%, is also likely to swing down 30% in the same year, during a very, very long volatile market, because that is the nature of the stocks. And someone told me about that. Okay, what do you expect of stocks? Do you expect it all to go up but never swing down? I mean, No, when you invest in stocks or even commodities, it's normal for it to swing because it's just what it does for stocks or commodities. It's like you're expecting Christmas. Christmas is coming every year, so you have to expect that, right? But private equity is not so volatile. The reason being is because the underlying asset itself. Okay, I will explain more on what are the underlying asset of this private equity, right? But just to keep in mind, in any investment, and not just private equity alone, we look at two things, which is the return and the volatility risk. So what it means by that, okay, I'm going to skip to this, what we call as risk-adjusted return. Okay, if you go to places like fund supermarket, right, and for every fund, you can see that there's this metric called Sharpe ratio, right? Sharpe ratio. What it means by Sharpe ratio? Sharpe ratio actually takes your return and it divides it by the volatility or the risk of every investment. Okay, in these terms, it means that what is the average return of this investment considering the risk factor itself? Because we don't only want to look at the return, we also want to look at the risk. Now, something that gives you 20% return, option A and option B, 20% return per year. One, the risk, the volatility, imagine it is also 20% compared to a volatility of 10%. 10% is less volatile. Which one you want to go in? Of course, you want to go in what we call as the one that gives you 20% but with a lower risk. So what is the metric to quantify that? Is called risk-adjusted return. The return divided by the number of the risk. So this is what we call a Sharpe ratio, and you'll be surprised to see that. And this from from independent research. This is not from me, this U.S. data shows that private equity over the past 10 years, it has what we call as a higher risk-adjusted return compared to public equity. So higher return, lower risk. Okay, and the thing is, a lot of people will ask that when I first presented to my already clients, my clients, and they have a question to say that, hey Liu, why isn't there anyone, or why I have not heard about this before? Okay, the reason is actually quite simple, because it's predominantly reserved for only pension fund like EPF, and all that. Endowment fund, those funds are run by university like Yale University. I've shown the example. Family office, institutional investor like your insurance companies and all that, and also for the ultra high net worth individual. So it is normally for this group of investor, and that is why for retail investor, many people would have not heard of this. The other thing, of course, we have covered is good diversification from traditional portfolio of stocks and bonds. This one, and we know that already, we have discussed. Invest actually what's the underlying assets, private companies with significant growth possibility before they go public. Okay, but this is just one of the options. We'll go through an example later, right? Generally higher risk return or reward due to illiquid asset holding, because these are not stocks, right? And it's not really affected. It's actually not affected by any market sentiment for that matter, which is what it means by on the one hand, it's not affected by market sentiment, which means that even the market down, you can still make money. Market up, you can still make money, but probably not as much as the market, right? And the other thing is about illiquid, because your capital are locked. So again, some people will actually have to balance it up between how long my capital is being locked to how much return that I'm ultimately or eventually getting from this private equity investment. So again, because private equity, the assets are illiquid, meaning that it is you invest, then at the end of the period you cash out. So in between, right? In between, it is common to say that your capital are locked to a certain time frame. It could be 3 to 10 years, depending how it's structured. right? So you can't really like trade, right? There's nothing to check. There's no trading. There's nothing to check on your or whether today the price has gone up or what. So you really look at long term. Okay, you really have to know have patience, and this point is also very important, which means that the private equity return is very highly dependent on the fund manager capability to source for good deals and to squeeze out the return of these profitable deals or private investment. Because market will have no effect on private equity, but the manager capability to structure a deal and to source for good deals and to filter out the bad deals are very important, because if we get into a bad deal, then investor will actually lose money. Right? Okay.
Yeah, so in short, that the volatility is less because it is not traded publicly. It's more like property where you don't like sell and buy within a month or things like that, right? You do it over several years. So that's why
right.
you say emotion is taken out of that, so the volatility is less. That's why
right.
and the holding period is long, so that's give the nature. But what I'm curious about is when private equity we are investing in a business that is not yet providing their financial report publicly, right? So it's like kept to their own and to the potential investor, where only the fund manager will have access to that, right? So what we know is the startup rate, the percentage of failure is quite high. So as you say, so the fund manager's skill is very important. He really need to pinpoint maybe just 1 out of 20 companies is going to make it, so he have to find that one company out of that 20. So we are curious, how can he do that?
That is also this option. But I'm going to present to you like how they manage the risk. Like I say, I always want to look at the risk, because I always put myself in the shoes of my clients or the investor, right? What we know as a collateral. Okay, when by the end of the presentation, that will be pretty clear, right? So we will come to that. U.S. pension fund. Okay, this is again an independent report. Alternatives, private equity and hedge fund. So do not be confused with private equity or hedge fund. Private equity, you have the underlying fundamentals to back it up, meaning that they are real tangible asset, or they are real tangible cash flow. Hedge fund, to differentiate hedge fund, it could be invested in private equity as well, but hedge fund are what we call as they are probably still market correlated. I mean, they are still related with the market. For example, if they hedge fund that bets like George Soros, more than 10 years ago or 20 years ago, when it bet against a certain currency, let's say Thai baht or Indonesian rupee or Malaysian ringgit will fall. So, excuse me. So he's making a bet. So because you know that, okay, this economic crash is coming, your company is doing bad, I'm betting that the currency will go down, and he make a huge profit from there. And those are hedge fund, right? Hedge fund. So today we are not talking about hedge fund, right? So because we are talking about private equity, which have the very solid fundamentals. We have tangible assets to back it up. Because why I stress this a lot, because we want to look at the risk, and we want to know the risks are well managed. And you see that over the past 10 years, independent research survey tells us that more and more allocation are being invested in private equity, because it's more certainty. Okay, very important word, certainty. When you have less volatility, you have certainty. Okay, so let's get to the details of it. So when it comes to private equity, there are a few things that an investor, or the common what we call as terms that everyone want to know about. First is what we call as absolute return. Absolute return meaning that a private equity is like your binary number. It's a 0 or 1. It's either you make money or you don't make money. That's as simple as that. There is nothing to say that let's say I run a unit trust fund or fund that invest in Asia Pacific stock market. Now, Asia Pacific market, China is one of in Asia Pac, the market. So what happened if China, that China stock market has dropped, like 30%. Now, if my funds, it only not only invest in China stock market, I invest in Singapore and I invest in Vietnam or what. So my funds actually, the fund manager says that if I manage an Asia Pacific fund, my fund dropped by only 10% only, but I benchmark it against overall, okay, my peers and my market, China market or what. Even though the fund dropped 10%, if the market dropped 30%, then I say I still perform because I outperform the market. And this is what we call as relative return, okay? But absolute return is a term to say that you either make money or you don't make money. You don't tell me whether you outperform or underperform the market. So private equity is under this category. Okay, it has nothing to benchmark against. It's either you lost or you make. Okay, very exciting. Okay, loss or you make. So that is the first. The second thing you want to be aware of this term when it comes to private equity is what we call closed end and lockdown. Okay, again, reiterate, closed end meaning that it's normally not open for subscription or open all the time. It has a limited period, right? Because time and projects or these startup companies or opportunity don't wait for no man. Okay, so only this time, if you don't invest, then that's it. So it's normally closed end, and it normally has a lockdown, like say 3, 5, or 10 years before you can cash out. Now, the underlying thing, how a fund manager actually invests in a private equity is in one of these methods. One, what we call as equity financing, meaning that I inject, let's say Casey has a company and a startup company, and I inject a capital of a certain amount as a working capital for Casey Lau's what business you want to do, Casey, if you are not doing this line?
I don't know. Let's say mobile app. Okay.
Mobile app So mobile app, okay. So mobile app, I say that very prospective. Oh, mobile app is something like Grab Taxi or Uber, right?
Okay.
So very prospective. And imagine I encounter this opportunity very early in the days. I say that I inject $100,000, okay?
Okay.
Series A financing. So in return, I get a 10% or 20% stake in Casey's company. Okay, even though it haven't go private. So this is what you mean by equity financing. It's like buying a stock in a market, because stock you own a company, but this is more on a private company, right? So this one way you invest in private equity. The other way is called debt or loan, meaning that mobile app, Casey's mobile app, probably you don't want me to go in and having a stake in the company, right? And he said that, okay, I don't want you to come in, but I still want my money. So I inject this same 100K USD. In return, I sign an agreement, a deal. I say that, okay, this at the end of the next 3 years, minimum I'm getting my capital. But in between, every year you pay me 15% interest. Wow, this one like loan shark, right? So 15% interest, so 15% interest out of 100K, right? So this is what we call debt and loan, no? So I cash out at the end of the period, but in the interim, I'm getting cash like rental income from you. So this is called as a debt or loan. These are also possible ways to structure it, right? The next one is called a structured debt. Structured debt meaning that it is almost like on the 3 years, it's like a debt and loan. But if KC mobile app goes public after 3 years, go IPO, then I want to convert this into an equity stake in KC's mobile app company. So this is what it means by structured debt. Okay, it's a combination of equity financing and debt or loan, right? So The other thing would be what we call a senior loan. Okay, senior loan meaning that Casey's mobile app, he might not raise capital from me alone. So he also raised capital from other investor. Okay, and senior loan, it refers to the investor, normally in terms of some financial institutions that loan the most money to Casey's mobile app company. So he has what we call a senior loan, right? So if Casey mobile app company goes flop, right, whatever tangible asset to be liquidated, to be repaid, the senior lender has the right to claim first, the first right, first charge, first lien, senior loan. Okay, so when I go in, so it could be that I'm not a senior loan. So after a senior loan I get if I'm not a senior loan lender, but I could write on the back of the senior lender. I write on the back. So I'm also a senior lender, but my capital is only 100K compared to, let's say, 1 million or 1 billion. Okay. Mezzanine financing, of course, of course, it's almost like a senior loan. But just for this presentation, I simplify it. It is comes in second tier after senior loan, right? It doesn't write on the senior loan. And the other thing is that when it comes to this kind of private equity deals, so again, the skill set of the fund manager to structure and the source for profitable deals are very important. But again, a good fund manager would not be so dependent on his skill set and go overconfident to say that when I go into this investment, she'll make money one, okay? Because nobody can guarantee. So what he do? He manage the risk. He managed the risk by having a collateral. Now, in case of a company, the collateral could be the tangible asset. The tangible asset. Now, if it's a service company, the collateral could be an intellectual property that it could bring value to the market. That if you want to sell it in the market, it has dollar and cent attached to it. And this is not what the company say. If I'm the fund manager, I want to engage an independent appraiser or valuer to actually value this intellectual property or tangible property to say that whether this kind of property is really worth what is the market value. So I will engage a valuer to value that, so that when really a project or a company or a deal flop, at least I know I am getting something back. I have your asset, the collateral to back it up. You see, it's like a house, right? It's a house. Why, when we do, you want to sell a house, if you're in a sub-sale market, the bank have to have a valuation. It's not to say I say my house, what is the market price. It doesn't work that way. So if you use the same concept, then I think it's very quite simple to understand. Of course, there might be situation where you really cannot have any collateral, especially if a new startup, a mobile app, right? So it's not well known yet. You cannot really put a dollar and cent into that yet. So how to manage the risk to say that if a private equity opportunity comes, a fund manager manages this by not only investing in one project. So it may be only allocate 10% of the total capital raised only to that project. And that's why you limit your downside, okay, in case there is any, right? So again, if I summarize it in what we call as an arrow, to say that on the very bottom part you have a collateral downside protection, what we call as senior secure or collateralized. So downside protection, things go sour, I have the asset to back me up. So if your asset is worth 1 million or 1 billion, I only loan you half of the asset value, 50% loan to ratio. So meaning that if this project flop, I liquidate your asset, I have more than enough to cover what I loan you. You cannot loan the full amount, not like 90% loan like the house. So it normally doesn't work that way. So the next best thing is about what we see in the blue section here is what we get debt-based return. Like I say, as long as my capital was locked by investing in this company on this project, every year I'm getting a definite return. Okay, what we call coupon payment or principal amortization. Now, of course, the next best thing will be, I hope that whatever I invested it will turn out to grow beyond my expectation, meaning to over deliver. So in that sake, so my profit I cash out not only my capital, I also cash out additional revenue or capital gain for those equity. And perhaps if it is structured debt, then it means that when you go public, let's say for a company, I will have a stake in this company itself. All right, so I think that was quite a mouthful. All right, so this would be what it looks like. Again, this is something that I screenshot from the net. So this is how normally a private equity, if they want to structure into a fund, normally it's in a fund or trust, right? A fund or a trust, because this structure is like a unit trust fund whereby you have an independent trustee to hold the money. The private equity fund, the fund manager, only provide the fund management or investment management to the money that is part under the fund, which is governed by the trustee. So the trustee actually acts on behalf of the investor, right? So you don't give the money to the fund manager. It's the same. I mean, the safest kind of private equity arrangement would be similar like a unit trust arrangement. You have a trustee, you have fund manager. The fund manager charge a fee, and the trustee will act on behalf of the investor to, if the so in that sense, the fund manager cannot run away from the money, not unlike the scams that you have heard, like Geneva Gold, or some cafe business or MLM and all that. So the structure is like that, and the best, of course, it is regulated by Security Commission as well. So the private equity fund will actually invest in multiple option investments. It's called portfolio. So normally they invest in a few portfolios, so they diversify the risk and to expose themselves to different kind of projects in different regions and all that. Now, let's go to this example of an investment, and this is a real case study. I think I need to get the.
you need to turn it off. Yes. Yeah. It's pretty nice music though. So if you have any questions, just type in the chat box. I think we have a question from Brian. I'll address it later.
Right, I'm back.
Yeah, you're back.
Yep. All right. So one example of a private equity investment will be something that taken from this one of the projects that's running. So what this example shows you is that it combines all of the concepts that we have discussed just now for the past 45 minutes. So one is to say that you can see that this project is in Philippines. It's a place called Clark Freeport Zone. So this Clark Freeport Zone, the backstory is the backstory is that in Philippines apparently most of the lands, or the plots are freehold, freehold. And when it comes to a leasehold land, and this developer want to develop this land, the land bank, right, for a logistic and business park in Clark Freeport Zone, it's a leasehold plot, and bank do not know how to proceed because bank normally have this strict procedure, right? This strict what we call as a qualifying procedure. Okay, you must meet this criteria A, B, C, D, E. So if you say, oh, criteria A don't meet already, so they say that we cannot approve, right? We cannot approve the loan. So which means that if this kind of thing happen, if you're the developer, you have to find another way to fund your project. And that's why he looked outside, and the unconventional way of funding is to look for angel investor. Okay, so imagine if it comes to you, and you as an investor, you do all the due diligence, and you say that okay, you got funds, you can invest in this project, but because you cannot get bank loan, so when I loan you the money, I'm going to be a tai loan. Loan shark lah. Okay, a bit like a loan shark, I say, a bit like a loan shark, but with wings, with angel wings, right? So, meaning that the interest that I'm charging you, it would not be so low as the bank already, because in some way you're already desperate, right? That's why you come to me. So I'm going to charge you an interest rate of, let's say, 20% per annum, 3 years term. So if you are an investor that invests in this project or this kind of deals, so actually you are getting 20% per annum, right? Because this is already a negotiated deals. So the fund manager, of course, has to have the network. He has to have the legal tax, support to actually source a kind of deal, and to have all the documentation done to do all the due diligence to say that okay, I think this is very good area. It could be very profitable. It's just a minor setback because it's a leasehold land, which is really nothing, not really not a big deal. So they're going to fund this project, and of course, you see this loan to value 20%, meaning that if I'm to go in, I also want to have a 3 independent valuer appraiser to value the land. What is the value? And what the value is as such, I only lend you 20% of the value based on the independent valuation. So in that case, it protects my risk. So even if the land value is to drop, let's say 50%, it's also more than what I have loaned you in the first place, right? So it's secure by what we call first lien charge on the assets. Okay, and the other thing about a project like this is that the fund manager is also not what we call as a major or big investor, meaning that this is where the moment where herd mentality is actually good. Herd mentality, so you follow what people are doing, meaning that if you are the biggest investor, then you're a bit afraid, but you say that okay, let's say this project, who are the other investor bigger than me? So in this project, it's one Kuwait Wealth Fund. They say, oh, this guy is a big investor, and they explore a bit like whether this project is going to go. Is that see how the relationship works between this Kuwait Wealth Fund and let's say the Philippines government. So essentially, you're actually following to say that, well, if a big fund or a reputable company or organization is already investing in, or a big bank, right, investing in, then I only invest probably 10% of what they invest, so I just follow them. So again, like I say, this is where the herd mentality is probably good. So you see who are the investor. So yeah, I mean that would be one of the example, okay, that covers a lot of things. First is a risk management, how they manage the risk. Second is how are the underlying asset, what are the underlying asset, and how are the returns are. These are the interim, what we call as dividends, right? What are the method of financing, what we call as a senior financing, and of course follow the herd kind of mentality. Okay, so right. Okay, I think I actually left out one point to cover for our audience today, is the fact that a lot of people never heard of private equity, because just last week I was chatting with one of my clients about this, and he said that he also have an objection to say that, hey, why can't I had never heard of it before one? So I tell him, okay, so this guy actually work at Nestle, right, sales manager. So I told him, I say that, okay, if you want to push your Nestle products to the market, to your distributor, would it be more prudent, would it take less work and easier to actually talk to Tesco or to talk to 10 small kedai runcit? Because it probably takes you the same amount of sales, but the effort of talking to 10 kedai runcit or even 100 kedai runcit compared to one Tesco is probably more tedious. So that is why private equity, when they want to raise capital, they are not so interested in, I think most we are not so interested in talking to what we call as retail investor. Okay, they are more interested to talk to pension fund, EPF probably, right? All those big funds, because this is where they can raise really big money. And for retail investor, if the opportunity arises, we just ride the wave. Okay, we just ride the wave. And this thing, coming back to here, do you know, I think it's, probably most of you don't know Ashton Kutcher. Ashton Kutcher is a very well-known actor for many English movies, right? Western movies. So it's based in US. And do you know Ashton Kutcher? Yeah, he's an actor, but he's also a tech investor. So he founded what we call as a A-grade investment, to invest in private equity, to invest in companies like Spotify, Airbnb, Foursquare, Uber during very early days. So you see that really good business-minded and really savvy people, they are really exploring into private equity as of now. So again, you can see that there is always risk and there's always reward when it comes to private equity, right? So again, see how you look at it. Danger versus opportunity, right? Where there's danger, some people see danger, some people see opportunity. So what are the expectations of return? We will say that very realistically about 15 to 20% net per annum. So to make it in very simplified terms, double your portfolio in about 5 to 6 years, right? Based on the rule of 72. Lockdown period, it could be 2 to 5 years, some are even 10 years. Underlying investment, it could be in projects financing. This is the example that I give in project financing. These are projects, so it's not company, these are projects, right? Project financing, real estate development in a trust kind of form, startup with niche markets. So what we recommend actually people to invest is not the so-called private equity or hedge fund that involves forex trading, that involves options, that involves commodity, because these are really placing your bets, right? But we don't want to bet against this kind of trend. Minimum investment, it could be 50K, it could be 100K. Current, I mean some options available, 100K. Feeding into primary tranche, meaning that these private equity funds, I think in Malaysia is still very, very new. When opportunities are available, normally they come from Singapore. And all those funds are actually funds or projects or arrangements are in Singapore, whereby the minimum everything in Sing dollar or US dollar. Okay, so when it comes to Malaysia, they actually say that same amount, but they say in Malaysian ringgit. So again, like I say, the cons will be moderately high to high hurdle of entry in terms of capital, depending on how many you want to allocate your investable amount to allocate into this private equity. If 100K is all that you have, I say that you really have to evaluate your options, whether you need this 100K cash for emergency or not. Okay, and of course, private equity are closed end; they are not available all the time, only as and when. The pros of this private equity, of course, would be the main one would be they are not correlated with market cycle. So market up, you can make money, maybe not as much as the market. Some people say that I can make stock market 30% per year when the market is bullish. I think yes, but it's likely to swing down the other direction too. So it's a diversification, right? It's a informed diversification. Not market up, you can make money. Market down, still can make money. But when market up, you can lose money also. When everyone is making money, right? Fair comment. So yeah, I mean that would be all for me for today. I got one more slide, but let's go to Q&A if there's any, Casey.
Yeah, I think I pretty much answered the question as well here. Brian is asking about how do we, like, retail investor get involved in this kind of private equity fund. So you say that the minimum is like 100,000, right? And just when it is available. So we got to have got to know these marketers. Basically, I think only the financial planners are carrying this product. Is it?
Yeah, actually, this private equity, they have a few ways of distribution channel. Right? These are normally they don't employ agents, so it's not like unit trust agent. You have agents to know this. Normally, they are available through banks. Okay, through banks. Why available through banks? Is also because banks have their own client base. In terms of private banking, if you are in private banking, I guess you will encounter this as one of the options beside fancy things like dual currency investment and all that. So if you're not, maybe you're in premier on normal banking, they probably don't even want to present this to you. Okay, but in private banking, I think they get exposed to a lot of this opportunity. Again, this private equity, you have to be very careful. You cannot say that, okay, I encounter private equity, then I invest. No, it's because you do not know what are the underlying asset and whether you are getting the short end of the stick. Now, these private equity firms normally they are available through banks, not because the bank are the fund manager. It is normally a private equity firm that has the people network and the professional, the people and the professional expertise to do this. They form a firm, and then what happened is they do a joint venture with banks, because first is they know bank have distribution network, and because second, when it goes under a bank, it becomes more credible, right? Especially if you are talking about major banks or international banks. So when it goes to banks, it's more credible, and it also, for us, we think that it's also more secure for investor. I'm not saying you cannot lose your money. I'm talking about on the regulatory standpoint, because you know that for private equity firm to go to joint venture with a bank, the bank would have to do their own level of due diligence. Agreed? If not,
Yeah.
I mean, you are actually spoiling my reputation, man. So the bank would have to do another level of due diligence. So then again, only then it will be available for their customers lah. So for us, for independent advisors like us, we also have access, because can't ask for it, and because we're independent, we also can go to a level where we can take these private banking level, private equity things for our clients. So yes, it will be normally available through banks, but banks, I would say that depending on your banking level, they may charge you higher for that. For us, if already a client, then normally we charge for this advisory, or even for the charges, for initial charges, it's a bit lower than bank, I would say.
Okay, good.
Yeah, Brian, does that answer your question?
Okay, yes, I guess so. And we have Clarice is asking about the return, where you say like got 15 to 20% return a year. Like, is it is the retail investor getting that return every year, or is it like only upon exit then you get all the money back?
Upon exit, actually, upon exit.
So you don't get anything
what-
until the plan is over, right?
Yeah.
Okay.
So what we call that, upon exit, if you get, let's say, is double up your money, right? Then you just annualize it. Let's say it's 5 years exit, and you double up your money. So you say 1 year about 20%, right? That is excluding whatever dividends, right? Whatever dividends that is being paid out. And I use the term dividend loosely here because they are not like dividend from public listed company. Those dividends come from the deals that those projects or company pay the interest, okay, the interest to the fund manager, then the fund manager distribute back these interest as a profit to the investor for in the interim period.
Okay. So basically it's upon exit and okay, this is a sensitive question. Quiz is wanting to know that for those like banker and financial planner like you carrying this product, can you disclose the sales commission?
I would say that it could range anything from 3 to 5.
3 to 5%. So it's more
Yep.
or less like unit trust, right?
Yep, that's right.
Okay, awesome. And so just now where you mentioned about that fund, the funding the project in the Philippines, become like using the senior financing, senior loan type
Yep.
of arrangement. So that
Mhm.
that investment is already over, right? I saw that it's like
Yeah,
September.
that is already over.
So you
That
cannot
is
get on
already
that
over.
one anymore, but you still have
Yes.
more coming.
Yeah, yeah, yeah. That's what you are seeing here is that there is another option which is why it just launched. Again, I'm not going to disclose what funds, but it's a closed-end fund, and it is also distributed by major bank. If you have access to that information. For more detail, of course, you have to go to. Casey, maybe you can copy the link for.
Yeah, I paste the link to all the audience so
yeah.
I got it.
Normally, I only disclose it via a one-to-one presentation. So on a public site, because we are independent, we don't want to be seen to represent any financial institution for that matter. So again, one of the things that I presented here is to represent how those projects are managed. Okay, so it's by the same team. Let's say by the same team and by the same committee, by the same fund manager. So normally, how this works is that they will raise capital first, then only concurrently they are evaluating deals that come to them. Okay, so it could take about 6 to 1 year before whatever they raise the capital are fully invested. Okay, so it normally works like that. So this is what we call as a historical, how they do things. But when I say that what available now is it's opening again for subscription, it is by the same committee. It's like your part 1 and part 2 and part 3 lah. Okay, so this is more like part 2. They are raising that again, so at least they have some track record to show. Because if a private equity fund have no track record, I'm not comfortable to actually present to you, even if you are very keen. So with some track record to show, we say that okay, this could be something that is viable. Okay, something that is available by not all, I think a few major banks. Okay, depending if you have access to those info or not. Again, some banks don't disclose it because this carry the title of a competitor bank. So that for us, we are very fair. So yep.
Okay, and Lim Chun Lee here want to know about during the interim, like how much the dividend payout, things like that. So I think it depends on the fund you're investing in,
Yes.
right? It's spelled out in the prospectus, isn't it?
It depends. I can give you, if I even say 3 to 5% per year. But again, these are historical, right? Historical. This is historical, meaning that there's no there's a trend in terms of how the fund manager conducts the deals, but there is no historical things to say that, let's say a company like a public bank, it pays 6-7% dividends, and if business is doing good, so you can forecast it's going to pay increasingly more dividend as the year goes by. So again, it doesn't work that way. So that is why really I cannot give you a forecast of how much dividends it has. Again, when we come to dividend, it's something that as and when always have this word as and when. So take it as a bonus. Yeah.
Yeah, and TP want to know, is there like any annual report by the companies that we're investing in? Let's say you're investing through this private equity fund that is investing in certain companies. So does the companies release the annual report to the fund managers, and we as investors, do we get it as well?
Right. The fund manager will actually filter out this detailed like annual report, if you're referring to the annual report for public companies. But on a detailed annual report like public companies, that would not be available. Again, if private equity, there are a few types. One is the type where they raise a capital, then they invest in a few project or few opportunity. The other type will be they only invest in one project, like a real estate development trust. That kind of thing, you have access to the very detailed information on how things are going, the facts and figure. But for this type A, whereby they have a collective investment like a fund, and they invest in the few companies. Normally, investors do not have access to the very detail of the figure of each companies, because one thing they disclose is to disclose what is the progress, how the projects are doing. But most of the time, even for this option, they don't even disclose what are the name of the company itself. Not even to our level, because they have structured a deal in a sense that they sign what we call as an NDA, non-disclosure agreement, with the fund manager and this company where they are funding. Again, it works. You can say it, or it's not transparent enough. I think you have a fair point, but imagine if everything is public, then public is already a public equity, right? So everything is available, and when everything is public, everyone knows about that already. Competitors start to come in. You can't really structure such a good deal anymore. So I would say it's a double-edged sword. Double-edged sword. Hope that answers your question.
Okay, good. And also, as you know, when we invest in any unit trust funds, they will have like interim report, stuff like that.
Yep.
So for this private equity fund, do they
Yep.
provide that as well,
Yep.
like interim,
They have-
let's say like
yes,
half
they-
yearly or yearly, or?
Yes, historical is half yearly. Yes, they do provide direct to investor, not to the public. But if you're an investor, then they do.
And then how is it like structured? You know, when just now you show a chart where the ownership is a limited partnership, where the big boys like the pension funds and all the high level
Yep.
individuals, they have their name as one of the partner of the firm, right? The LLP or LLC firm, right? So for us like retail investors, so we are like represented by the private equity firm. So we don't see our name inside there, right?
No, you actually represented by yourself too.
So our name will be inside that
Yeah.
limited
That's
partnership.
right. You know, no proxy, nothing. No proxy. You have an account.
Okay.
Again, different structure. This is just a general structure. The one that you have here is in the form of a fund. So it is like investing in unit trust fund, where you open an account, then you see your name there. No proxy or no nominee required.
I see, like your slide 15, the examples about
Yeah.
just now the deal in Philippines.
Yeah,
Like this one is like they require 10 million. So if you invest like minimum 100,000, then
Yep.
what you need is actually, I guess, like 100 investor. That's it, right? Am I correct?
Yeah. If you say about retail, that's right.
So so the company structure of forming that limited liability partnership is still okay, right? Okay.
Okay. Probably I could just this a general snapshot. Probably is a bad representation. Just ignore. So there's no incorporation of any companies or sort is required. It's just like one of the options that are currently open here is actually very simple. It's as if you are opening an account with a unit trust company, a platform. So your name is there, so you just channel money in, and it will be in that fund, I would say, in invested in that fund. And you can see.
So will there be like management fees charged and all those things?
Yeah. That will be. The fund manager has normally about 2 to 3%.
Every year.
Normally, yes, that is right. So you have to deduct this. So deduct this from your return. 15 to 20%. Again, is already net. What we say.
So,
will
but
be
anyway, they already spell out the exit plan, right? Let's say after 5 years, then the
Yep,
investment
yep.
have to be resolved, and you have
So,
to get that money
what
back.
you have the visibility is at this level, right? Not at this level, okay, for retail investors. So you have visibility on this level, and they even you don't want to cash out, they also want you to cash out because it's a closed end, meaning that they are closing that. Okay, so open for, let's say, for limited time. So the one that we have is open probably until end of November or mid of November, because they say that they open at this time frame or until they raise a certain target of capital, whichever comes first. So they might close early, right? So when they close, then that's it. I mean, no investment. They don't take any investment anymore, and it spell out that it will be locked for, let's say, 5 years. Whereas the 5 years, you cash out, you cash out, and whatever in the interim will be paid out to investor directly into their bank account. It's not reinvested. Whatever is paid out, it's not like unit trust. It is not reinvested. So it will be like you're getting a cash, like cold cash. This is what we know from fund manager, and this is what has happened historically.
Okay.
Yep.
Okay, let's get to the very last questions. We have a very good question from Vincent here. He wants to know that how do we justify that a private equity fund is good to invest? Like any criteria that you can give us, say, the management team or the potential of the business or the things like that. So, what is the criteria that you can give us a guideline?
I would say that I would say track record because when track record very important, and because track record, it reflects the person behind it, and if the track record is no good, I think that kind of speak volume about the person behind. So I don't even want to talk about the return, because I always believe that the return of capital is more important than the return on capital, meaning that you don't fall into a scam, right? So historical record is very important. Track record. The second, I think probably this is the second thing, but the first thing is whether it's regulated or not. Regulated,
Yeah, there's a question
regulated.
here asking about regulation, like is it regulated by Bank Negara or SC in
Regulated,
Malaysia?
okay. If it is regulated, and what I have it is regulated, meaning that if you have a prospectus approved, okay, by SC, then it's regulated lah.
Yeah.
Okay, regulated doesn't mean cannot lose money. Regulated meaning that it's not a scam.
Yeah.
Okay.
It's not money game or things like that.
Right.
Okay.
It's not like banking. And if you go to banks, if they let you access to this, banks are also distributing it,
Yeah.
right?
Okay.
So it is not something hanky-panky, a company or what. No. So this private, the talk it is distributed to the banks, but the banks, the actual management is done by a joint venture private equity fund based in Singapore. So it is actually available via Singapore and Malaysian banks. Okay.
So
So
how
I
about the
think-
tax treatment, right? How about the tax treatment? Like the profit you made, is it like depending on the country of the projects or things like that?
Oh no! If it is already in the form of a fund in Malaysia, so it would be treated as in Malaysian tax law. So whatever what we call as capital gains, then it's not taxable. So it would the tax would not be evaluated at this level. It is evaluated at this level, right? And yeah, so it would not evaluate.
So
at
by the
this
time
level.
you get that money is considered capital gain or after tax already, right?
Yep.
Okay.
Yep.
Awesome. So I guess this is really an eye opener for most of us here to understand about this private equity. And if you want to know the latest private equity fund that is available, and where my friend here, Liu Cheng Fu, is distributing that fund, then you have to engage a one-on-one face-to-face meeting with him. So just go to the link that I just post to you. Maybe you can open up that link, right?
Yeah, this
So
link
that you can
actually
see the form.
it's actually in a blog post that it's actually a blog post, yeah. So you go to my website, it's actually this. So there's a Google form that actually says.
So you embed here, right?
Yes, it's already embedded. It's something
okay.
that I did. So again, you can speak for more details over here. And this is an article by itself, but at the below there would be. It's. I think is this showing on your site, Casey?
I don't.
There's some.
I don't see
I'm
the
not sure.
form. So maybe you can just
Yeah. I mean, is it
load up
if you
the
open
Google
your
form.
browser? Is that what? Just to make sure it's not.
Can you load the Google form directly? Probably it's better. Also, the link that you sent to me is actually going to your blog post, is it?
Yeah. It is. It's supposed
okay.
to be.
So it's going to your blog post, and I'm trying to
Yeah,
locate your
but I'm
form.
not sure. I supposed to have a form over here.
Yes, I see the form. It's a request for.
Yeah, so it's
private
only
presentation.
my site. It's only my site. It's having some error. So
Yeah, maybe
no
you
problem.
install some plugin that block the embed. So I'm showing
Yeah.
on my screen over here.
Yep, that's good.
The people who watch the recording will be seeing this.
Right.
Okay.
So it's one-on-one, but it might one-on-one. The arrangement is normally also to a conference, if you are
But
not.
do you know when is the due date for this particular fund that you are
I would
you are
say
distributing right now?
end is about 45 days from now.
45
That
days, so
was
it's
the
like
plan.
maybe
Yeah,
mid
it
of
could be
November,
early.
right?
That's right.
Okay,
45
awesome.
days.
So thank you very much
Thank you.
for that. And if you couldn't load the form or anything on that page, just I think just email Liu directly. Can you
You
give
know
out
where
your
to find
email?
me.
Yeah. Or you
Yep.
can go to his website, howtofinancemoney.com.
Money.com.
Then you'll be able to connect to him. So thank you very much for attending, and we'll see you again in the next Casey Lau's Money Tip shows. We have a very vibrant crowd today. So thanks also Liu for your presentation here, and thanks for
Thank you very
us
much.
understanding about this private equity fund. So good
Yep.
day to you. Bye bye.
Bye bye. Thank you. Bye bye.